What to make of the market right now and what your strategy be like? Let's try to decode that with Mr. Sunil Subramaniam joining us on the show right now. Good afternoon, Mr. Subramaniam. Always a pleasure having you on the channel. Hope you're back in India or still enjoying abroad.
I'm still in Singapore.
All right, but you're still there. So you're still with us tracking the markets. Mr. Subramaniam, let's start with the pharma space then, because two major companies, they did report the numbers. Dr. Reddy's still a buzz because many investors are looking 2 quarters ahead where semaglutide opportunity could be through. Even Cipla managed to surprise a bit on the earnings front. What do you make of the pharma space right now? Is it because the stocks were very tempered of late? That's why we are seeing a bit of a rebound from lower levels? Or do you believe that good time ahead for the pharma companies?
So actually, first, like you said, why were they under pressure? I would call it the Trump effect, right? Mr. Trump has been going on and on of charging heavy pharma tariffs. He's actually not done anything about it. He's just been talking. But every time he talks, there is a nervousness around, is he going after the CDMO players? Is he going after generics? How is he going to manage? So I think that's the Trump nervousness which has affected the pharma space, and that's why it was under pressure. So today, when individual companies are reporting numbers which are good, I think the market has no choice but to go and buy those because at least they have indicated their own future in a good manner. And to the extent that some of these might not get impacted by tariff, there is a window there. Pharma also contains a lot of domestic oriented things like hospitals and diagnostics, which are not in any way affected by the tariff thing. So overall, pharma is a defensive play. And one of the reasons why I think pharma underperformed in the past is that FIIs are the ones who have caused the selling pressure. And as you know, external oriented sectors are something that FIIs closely track. So I think the bounce back that you're seeing in the pharma post results is still driven by DIIs. So I think FIIs are yet to make up a distinct position on India. They're still, I would say, a bit wary about India because the delay in the BTA is not auguring well from their perspective.
Right, Sunil. So, hi, this is Nehi also joining in. Want to get your overall sense on where you are seeing the market headed right now, because we have been consolidating for the last couple of months, if not more, and we have been stuck in this range. Now we are even below that 25,000 mark. Going ahead, we were expecting triggers like earnings or for instance the UK-India FTA, but that's not had such a big impact on the market. FII flows on the other side are drying out. What is your sense on where the market could go ahead and what could be the next big trigger?
So I think the first thing is we need to understand the market movement over the last 3 months, right? So if you see here, starting post-March itself, FIs actually in April, May were buyers, right? In June also, the buying was there, though it was less. At the same time, if you see in the last March end, mutual fund DIIs, right, of which DMFs are a big part, had built up their cash balances to, I think, about somewhere around 7.25% of the total portfolio, right? But over the months of April and May, mutual funds and FIs both were buyers, and that's why you saw some support to the market. But from this beginning of this month, what's happened is that I think mutual fund balances are again down to the 5% level, which is broadly a bottom. So what has happened is that I don't think DIIs now have that much cash. You have fresh SIP numbers coming in. So that's what they can deploy, right? So the first thing is that I think mutual fund last earnings season, looking at the results, looking at this, domestics have largely deployed their cash and today don't have that much cash as they had a couple of months ago. FIIs, on the other hand, what's happening is that because of the BTA signing, right, everybody expected by July 9th that there would be some action on India. Then July 9th has become August 1st. But now it doesn't look, because the Indian trade delegation has gone to the US and come back, but still don't have a deal with the US inside because there are sticking points around Agri. There are sticking points between India and US, which is not easy to solve. So now it looks like even the August 1st deadline they will not meet. And then whether Mr. Trump will extend this 10% pause, which is till August 1st, let's say till September 1st for India, or is he going to slap 26% tariffs on India 1st August? And then when the deal gets signed, he will come back. Like that's what happened to Japan, if you recollect, right? He used the deadline to increase the tariff and then strike the deal at 19%. So this relative uncertainty around India and US, whether we are really going to do a quick BTA, and if a BTA happens, it looks like a 3-part deal, an interim deal, and then another deal by fall, which is like a phase 1, and then another one may take a few more months because there are a lot of stickly points that need to be tackled. So FIs have been a bit cold around the India because they're waiting for this certainty. Second aspect which has forced the FIS into this action is China. Because the China and the US have kind of come to an agreement on the tariff, though they haven't signed a proper BTA yet, the fact is that the Chinese market has been beaten down so much that its 1 year forward PE is at 11 and India is at 22. So if you look at it, it's half of India's valuations, and the Chinese economy is what 4.5 times bigger than India. So the point is that even at a 4% growth rate for China, those numbers are huge. So a lot of FIs are now finding value in China to go and put in the market. So some amount of attention has been diverted away from India into China. So then that brings me to what's the next trigger? That's the question you asked. So clearly some good news on the BTA front, that some interim is being signed or the tariff levels are going to be pegged at say below 20. That's what I think will be a trigger for FIS to come in. As far as DIS are concerned, it's clearly the developing earnings season. You know, the earnings season has been mixed. Some earnings have been fairly decent. The IT sector, for example, I don't think the earnings are so bad, but their guidances are a bit weak. And because FIs are not putting money back in, there are no buyers for the IT space. So that's why IT is under a lot of pressure. So why I'm saying this is DIS, because they used up a lot of their cash. Now the incremental cash coming in from fresh purchases over the course of this earnings season, plus the results will take their, buying will be specific to those triggers.
Right.
So those post good results, good guidances will get the DI allocation. So it's a mix of BTA plus the earnings season. That's the next trigger. And early festival season, if it gives a good indication around consumption, will be a good positive for the market to look forward. But until then, expect a sideways consolidating market for some time.
Okay, well, so we're still expecting some consolidation and some sideways momentum in the near future at least. But on that note, we'll slip into a very short break and be right back to take the conversation ahead with our technical experts too. So you stay tuned and we'll be right back. Hi there, welcome back to Closing Trades. And before the break, we were talking about how the entire financial services space is marred in today's trading session. Let's talk about Bajaj Finance, Shriram Finance. In fact, both of them are seeing cuts of about 4.5% and 3.5% each. IndusInd Bank joins that list along with the Bajaj Finserv. So it's entirely the banks, financial services, as well as PSU banks that are not doing well. So the entire financial basket is rather harrowed in today's trading session. But while we are talking about the top loser here, that's Bajaj Finance, down about 4.5% on the back of numbers that were slightly better than estimates, but it's actually the management commentary wherein they say that this year could be the weakest for the MSME segment. They see some weakness persisting over there. Until they have some clarity on that front, they've refused to share any guidance over there. So that is something that is not being taken very positively by the street right now. Other than that, you have a brokerage cut also coming in on Bajaj Finance, wherein JP Morgan has cut their rating from overweight to neutral, with a 20 rupee price cut also coming in on the price target for the stock. Earlier in the day, we spoke to Elara Capital's Shweta Daptardar, who believes that NBFCs could continue to struggle with asset quality woes, while adding that rationale behind reducing their price target for Bajaj Finance and its housing arm as well. Let's go across and listen in to what she had to say.
Have slightly tweaked down our target price and reduced slightly the multiple for the subsidiary of Bajaj, that is Bajaj Housing Finance. And that's primarily also because there is pressure from the competitive intensities that is flaring up on the housing finance side as well. So yes, we have slightly tweaked down, while our long-term opinion remains very constructive and positive on Bajaj Finance. But the interim for next 1 year, and also given the fact that stock has rallied quite sizably from 700 to 900 plus rupees in past 6 months, we believe in the interim periods, the valuations will definitely sort of be range bound. We all know that they have been running down on the auto loan books, so credit costs definitely have been emanating from that portfolio as well. So building in these continued asset quality woes, the credit cost definitely will remain sticky.
Okay, that's the opinion coming in on Bajaj Finance from the brokerage fraternity, but it's a mixed show from Shriram Finance, with NII seeing an uptick of 10%, but there was a decline in NIMs. Varun is here to help us understand what went wrong with Shriram Finance. Varun?
Definitely. So it's been a mixed quarter for Shriram Finance. Actually, if you look at the overall NII and PPOP of the company, that is less than what we were expecting. The NII growth has been around 10.3%, and the PPOP that has gone by around 8.8%. But if you look at the overall profitability, that is almost a little bit better than what we were expecting. We were expecting the profit to come at around 2135 crores. It has come tad above that, that is around 2156 crores. If you look at the overall AUM growth of the company, we are expecting the AUM growth to be around 15 to 17%. It is in between that, it is 16.6%. So it is actually on the upper end of what we were expecting. We are also expecting the overall CV sales to actually go down, the passenger vehicle sales to go down. But if you look at the overall CV and passenger AUM, that has gone up by around 12.2% to around 23.17%. That is for the PV. For the CV, no doubt, we have to get a clarity from the management whether it's the used CV segment that is doing good for the company, or have they seen any improvement in the new CV segment as well. If you look at the overall other segment, the construction equipment, that has gone down by around 3%, and also the gold loan business, that has gone down by around 18.8%. Also, we were expecting some improvement in the overall net interest margins for the company. We were expecting around 10 to 15 basis point improvement, but in fact the net interest margins of the company have gone down from 8.25% to around 8.11%. Basically, we were expecting an improvement because there were liquidity issues in the company earlier. Because of excess liquidity, the margins of the company were under pressure, but even this time the margins of the company are under pressure. So we need to understand from the management whether it's the excess liquidity that is still haunting the company, or is it something else which has impacted the overall NIMs of the company. So the net interest margin, they are less than what we were expecting. The overall NPA numbers, they are fine, no spike in the overall NPAs. But yes, the NII, PPOP, that is below estimate, the profit is above estimate, so it has been a mixed set for the company. Let's wait and watch for the management guidance as well.
Right, okay, awaiting the management commentary. But Sunil, wanted to understand what's your opinion on what's happening with NBFC, especially after that very cautious sounding commentary coming in from Bajaj and Finance, the mixed bag that we've had from Shriram. Can one deduct right now, so early on, that it could be a sectoral issue wherein there is going to be provisioning issues, and it clearly seems that the rural recovery as well as the SME and the MSME segment is problematic. Could it be a sectoral issue, or do you think it's more company specific?
I think it's basically two things. I think one is that we are going through this rate cycle change, right? With RBI announcing a huge amount of rate cuts, and banks are trying to reduce the rates, NBFCs have to keep up with them. So that's one issue, because the rate cut scenario passing on, because actually if you look at some of the bank numbers, their deposit growth was ahead of expectations. So that's the second point I want to bring in, that customers are still not willing to take whatever money the finance minister gave them and spend it. They seem to be saving it. So seeing it in the SIP book, you're seeing in the savings accounts of the banks. So the banks are actually getting good CASA flows, good deposit growth, and they are trying to reduce rates on the lending front. And the NBFCs, because they are ultimately dependent on the market borrowings, they don't have the benefit of a CASA book or anything for them to get, and they can't tap directly into savings of the retail mass in India. So to that extent, their NIMs will be under pressure, and the lending book, until the customer chooses to spend. But I'm optimistic about the future, because we have the festival season coming in earlier this year, and people's purchases tend to get bunched around festivals and Diwali and all that. And these counters, NBFC counters, are very good at the retail end, at the shops where these purchases are made, they convert quickly. So I would still remain optimistic that in the coming quarter, they would be able to grow their loan book quite well, and the NIM pressure will continue for some time, because banks are going to be breathing down their necks. So to that extent, that's why I said this is a transition period, because with the sudden rate cuts announced by RBI, the customers are expecting a sharp drop in interest rates. And how fast can these NBFCs reprice their liabilities, right? Because they have raised liabilities at slightly higher cost ahead of this time, and now they are finding the rates under pressure. So it's a period of a couple of quarters that there will be this readjustment phase. But once the festival season kicks up, I think these numbers should then pick up. On the asset quality front, yes, what Bajaj Finance said in terms of asset quality, that is anticipating pressure, has been a kind of a warning. Nobody expected that. That's probably where. So that we have now wait and see whether other NBFCs are also giving the same commentary on facing a pressure on the NPAs and the collections. But I would say one swallow doesn't make a summer. We don't have to rush into that judgment, because banks' NPAs have been by and large under control. I don't think it's been too much bad news there.
So, Sunil, a question really and purely from an investor perspective. If one has to put fresh money to work, is it quite an obvious choice there? It should be banks versus NBFCs, or would you say use this decline in NBFCs perhaps also to add positions?
I would say that it's banks versus NBFCs. Don't rush into the NBFCs. Wait for the commentary from the whole pack to come in and wait for the numbers from the festival season to trickle in to see whether sales are booming, because then you can correlate it to NBFCs lending there. But banks are a safer play because not only do they have the benefit of deposits growing there, the second advantage they will have is almost all of the big banks are distributors of mutual funds and insurance. And if the customer is saving instead of spending, then they're going to be beneficiaries of that from a fee-based income. So at this point in time, I would say the banks are a better bet in terms of that versus the NBFCs.
So that's the take on banks versus NBFCs, and Mr. Subramaniam is liking banks from that space right now. So thanks so much for joining us. On that note, we'll let you go. But let's also connect with our technical experts. We have Somil Mehta as well as Vinay Rajani joining us on the show.